So today's topic is related to corporate governance. What do you mean by corporate governance? Any clue? Any idea? See, governance is nothing but the act of the government governing its citizens by framing laws, rules, regulations which the citizen have to abide with or follow with. If the citizens follow the rules, regulation, laws which are made for their betterment, which are made to make their life more easier, okay, than miserable, then definitely it is governance. So the act of government governing the citizens, its citizens by rule of law is governance, and the act of the government governing the corporate sector by making rules, regulations, and even the judiciary implementing them, and the companies need to follow those rules and regulations. That is the most important part. So if uh, the companies which are regulated or governed by the government by rule of law is nothing but corporate governance. So let's see what is meant by corporate governance. What they have said, that means by which a company is operated and controlled. Yes, the means by which company is operated. See, company is operated as per laws, rules, regulations, and it is also controlled by the directors of the company. And who says that all this should be done? The company's law. So advantages of a company following good corporate governance. See, in corporate governance, the prime motive is that companies should comply with all the rules, regulations, and laws. Okay. So there are some points here. What is like good governance all about? The good governance is everything should be transparent. The company should not be hiding anything from their shareholders. Companies should be responding to the queries or issues of the stakeholders. Everything what is happening in the companies should be based upon consensus, individual, not individualistic. Greater participation of the stakeholders in companies' policies. It should be inclusive, like all the rules, regulations, and laws should be included. Rule of law should be followed. Things should be done efficiently, and the company should be accountable for its functions. Okay. So greater transparency, greater accountability, more efficiency in operations, better risk management, and less chances of mismanagement is what are the advantages of good corporate governance. Because of corporate governance, what happens? If corporate governance or compliances were not there, companies wouldn't have been more transparent. Companies wouldn't have been more accountable. Companies wouldn't have been more efficient. Companies wouldn't have had a better risk management. Companies wouldn't have had we cannot rule out any chance of mismanagement. More chances of mismanagement would have been there. It is the corporate governance because of which all these things are like happening with greater efficiency. Now, corporate governance code, the Organization for Economic Cooperation and Development, OECD, gives 6 principles of corporate governance. So what are those 6 principles? Ensuring the basis of an effective corporate governance framework. That means every company should have a very strong corporate governance framework. Generally, the directors of the company who are charged with governance are the ones who have to ensure that the company is following all the corporate governance codes or norms, or is following all the rules, is complying with all the rules and regulations. The rights and equitable treatment of shareholders and key ownership functions. Every shareholder should be treated equally. And as an owner, what kind of functionality they have. Institutional investors, like very big corporation companies, like in India we have LIC, Unit Trust of India, very big organizations. They are called institutional investors. Okay. So institutional investors, stock markets, and other intermediaries, about them also things are mentioned. The role of stakeholders in corporate governance. What active role the stakeholders can play in corporate governance? Stakeholders I will divide into 2 parts: internal and external. Internal stakeholders are the one uh, like uh, internal stakeholders are the one who are connected with the company, but internally external stakeholders are those who are connected with the company externally. And you know that internal and external stakeholders are who are the internal and external stakeholders, right? Because uh, we have already discussed about them in FR paper, right? Then disclosure and transparency. Everything should be very disclosed, and there should be greater transparency in the responsibilities of the board of directors. All these things are given by the OECD. Okay, that is Organization for Economic Cooperation and Development. So the UK Corporate Governance Code reflects the OECD principles, which is very important for publicly traded companies. So the UK is following the OECD principles, the UK Corporate Governance Code. Now, the corporate governance code, the code is split into 5 parts: board, leadership, and company purpose. What is the board's leadership all about? That means board of directors are there to lead the company from front. What is their leadership all about? And what is the purpose for which the company has been formed? Then the division of responsibilities, how the responsibility should be divided, composition, succession, and evaluation, audit risk and internal control, and remuneration. So all this, the corporate governance code is split into these 5 parts. So let us understand each and every part very clearly. Board leadership and company purposes. To create a successful company, the board must promote long-term sustainable success. That means the company should not be for temporary periods. It should be for a longer period of time. So they should the company should sustain for longer period, and that is called a long-term sustainable success. So the board should always promote promote that the company is going to exist for a longer period, and it's going to sustain for a longer period. And uh, like uh, like how successfully they're going to operate for a very longer period. They have to they have to create awareness regarding that. Then how the board of directors should explain that the company how is going to generate value for shareholders, which is very important. Okay, then the board of directors have to uh, like uh, ensure that the company is established for some purpose and has values and will work on strategies. Then the board must lead by example and promote the desired culture. That means what is followed in the company since longer period of time should be should be followed. Whatever the customer is there related to company. Ensure the availability of necessary resources for meeting the objectives of the company: man, material, machine, everything. Establish effective controls for risk assessment and management. They should do the risk management part as well. With their own member, one can be risk director. Ensure participation not only for shareholders but also for other stakeholders. Yes, shareholder is one amongst all the stakeholders, so it's not only the shareholder but other stakeholders should also participate. Ensure that workforce policies are as per company's values and take action to manage conflicts of interest. These are all the board must ensure. So the board is all about what? There is a chairman who is like the one who will chair the board. There will be a chief executive, CEO of the company. Under them, there are executive directors, and under them, there are non-executive directors. So this is the board all about, board composition. Okay. So these people have to report to these people have to report. That means these people will give more of suggestions. They are more independently working. They are not the ones who are involved in companies day-to-day operations, but they have certain role to play, and they will be more of giving suggestions, and they will be more independently working. So they have a greater role to play under internal controls. The executive directors have to report to chief executive, and that is CEO, and chief executive has to report to the chair. So there goes. The chair leads the board of directors. The chairman of the board leads the board of directors. He is better effective when he is independent, Yes. He enables free flow of communication at board meetings or with external auditors. So he has to enable or he has to make sure that the communication like of the board meetings is like is been given, and also whatever discussion happens in the board meeting or with the external auditor, this should be communicated. Okay.
So,
Yeah,
independent as in?
they should be working more independently. Independent, see, they are employees of the company, but they should not be working under any pressure. Are you
Okay.
understanding?
Yes, yes.
So whatever happens in the board meetings, to the external auditors, who is going to make sure the communication should happen? The chairman of the board. Okay, did you understand?
Yes,
Hello.
sir.
Yeah. So there shouldn't be any kind of pressure on them. So they should be making sure that all the communication is happening with the whatever the communication uh, whatever happens in the board meeting should be communicated to the or external auditors. Chief executive is the head of the executive directors, who has to ensure that effective operation, who has to ensure the effective operation of company. So chief executive, CEO of a company is the uh, head of executive directors, right? And the chief executive officer of a company has to ensure that company is operated very effectively and efficiently. Executive directors, they are responsible for running the company on day-to-day basis, and non-executive directors are employed on part-time basis in company. They are involved in overall strategy building, as I said. They also monitor the executive directors, yes, because they are more independent to do that. They participate in board meetings, become a part of subcommittee as independent and knowledgeable parties. Subcommittees are nothing but audit committee, risk committee, and then remuneration committee. So these are all subcommittees. These are formed for some particular purpose. This is for internal controls. This is for risk management. This is for giving remuneration to the employees, and on what basis. So the non-executive directors can participate in board meetings and be a part of all this, because the directors are the ones who are going to be a part of all these committees. They form the committees for specific purposes, right? Now, more on non-executive directors. Are non-executive directors paid any remuneration? It's a question mark. Yes, and sometimes their fees becomes quite expensive. Now, what are the challenges faced by non-executive directors? They are sometimes not sufficiently informed of the operations of the company. Yes, because they are independent, right? They are not involved in day-to-day operations. So there may be a tendency or chance that they may not be informed on various aspects. They also may have limited time to fulfill their role as non-executive directors. They may fail to report significant problems or may support unjustified actions of the board to be in their good books. That means sometimes what they do, they fail to report some problems or may support some actions taken by the board of directors to be in their good books. That means so that these non-executive directors can get chance for a longer term in the company. Okay. Now, board structure and composition. What is this board structure and composition all about? How you compose a board? The board should be balanced and must not be dominated by any group of individuals in making board decisions. Of course, that is very important. Chair should be independent on appointment. That means no one can sit on that chair. Someone has to appoint the chairman through voting process or through any process. The chair and the chief executive role should not be taken by the same individual. Yes, any person who is the chairman of the board cannot also be the chief executive. That means he may make the policies and he may implement. No. And like these two roles should be separated. Okay. Are you understanding? These are only making the policies and strategies. These are the ones who are going to implement through executive directors. So the point is If I make policies and if I only implement, I will never say that my policy has gone wrong or there is any kind of mistake in my policy or any kind of, or if my policy doesn't work out, I may not find any fault with my policy because I'm making that. So the role should be separated. At least half the board, excluding the chair, should be independent non-executive directors. Yes. So 50% executive, 50% non-executive directors. That means at least they are saying, and excluding the chairman. Board and its committees should have a combination of skills, experience and knowledge. That is more important to run the company. Independence issues in case of non-executive directors. Independence would be deemed to be affected if a director. What happens when do we see that independence is affected? That means the non-executive directors are not working as per their competence, as per their skills, as per their free wish and will, but they are pressurized to work as per someone else interests, vested interests. Okay, so non-independence would be deemed to be affected, yes, if a director is an employee of the company or group or has an employee of company or group in last 5 years. So see, when is the independence affected? When can someone pressurize the non-executive directors? When they have relations with non-executive directors, right? Whom the non-executive directors is not able to, object to their policies or to any of the decision making. So like if the non-executive director has been an employee of the company or group, okay, for last 5 years, then there's a chance that they can influence the non-executive director and they can get things done from NED, non-executive director, based upon their wish and will, who the company of which the non-executive director was a part of, or currently has or had within the last 3 years a direct or indirect material business relationship with the company. If the non-executive directors have business relation with the company, then also they can affect the independence of non-executive directors, right? Excuse me. Next, receives or has received remuneration from the company in addition to a director's fee. So if the non-executive director is receiving remuneration from company in addition to a director's fee, that means apart from director's fees they are getting extra money, so there's a chance of the non-executive director getting influenced or independence can be affected. Participates in company share option schemes or performance related pay scheme or company's pension scheme. So all these schemes, they will be looking for their own individualistic performance and trying to get good remuneration, or they may try to get ownership in company by getting the shares of company or pension. Has close family ties with any of the company's advisors, directors or senior employees. Holds cross directorships, or has significant links with other directors through involvement in other companies or bodies. Represents a significant shareholder, that means he's one of the biggest investors in the company, or has served on board for more than 9 years from the date of their first appointment. So all these factors can cause the independence of the non-executive director. Then appointment of senior independent director. One of the independent non-executive directors must be appointed as a senior independent director. So one amongst them, okay. The non-executive directors and the senior independent directors should meet without the chair present at least annually to appraise the chair's performance. That means the chairman should also be, the one whose performance evaluation, how he is performing, he or she is performing, or how has the performance been since long time, has to be appraised or evaluated. So non-executive director and the senior independent director will do that. Okay. And see, director should be working independently. We discussed right now. So senior is nothing but he's been working in the company since very long time. So one of the independent non-executive directors must be appointed as senior. So there are suppose 5 NEDs. Out of that, one person can become the senior independent director. And this senior independent director and these NEDs should assess the performance of the chairman and see whether there is some appraisal or whether the chairman has performed well, or some kind of appraisal can be done, some kind of promotion, or some, in the sense, some kind of remuneration can be increased. Non-executive directors appoint and remove executive directors and scrutinize their performance. They can do that. The responsibilities of the chair, the chief executive, senior independent director, board and committee should be set out in writing and publicly available, should be disclosed to the shareholders. Annual report should set out the number of meetings of board and its committees and the attendance of each director. All these points are corporate governance related, compliances related points. Okay, all this should be complied in a company. Full-time executive directors who are working in the company must not take more than one NED role in the FTSE 100. This is a stock market exchange. Appointment should not be made without prior approval of the board. So any full-time executive director who is working in the company must not take more than one non-executive director role. That means if he's taken one role in a company, he should not take another role in another company. Okay. Which company which are registered in FTSE 100? Are you understanding? Please tell me.
Yes, sir.
Yeah. So any company which is a part of this, if one of the executive directors is in one of the companies, they cannot become the director in another company. Okay. So full-time executive directors must not take more than one NED role. That means they cannot take the non-executive director role in like any other company. Okay. So full-time executive directors must not take more than one NED role. So they can take only one role, not more than one role in any of the companies which are registered in FTSE 100. About the nominations committee. So this is also one of the subcommittee. This committee is meant for appointing the board members and senior management. They are the ones who are going to nominate the board members and senior management. Majority of committee members must be independent non-executive directors. Okay. In which nominations committee, the chair must not be a member of committee when the committee is dealing with appointment of their successor. Okay. All directors should be subject to annual re-election. Again, election should happen to appoint them. The chair should not remain in post for more than 9 years from the date of their first appointment. That should not happen. The period can be extended for a limited time to facilitate effective succession planning. That means next director should come into picture. There should be a next chairman, in the sense, formal evaluation system to check the performance of board, its committees, the chair and the individual directors. Without performance checking, how will we know that how they have performed and they have taken a lot of remuneration, right? So they have, their performance has to be assessed. The chair must ensure a regular external board evaluation at least once in every 3 years in case of FTSE 350 companies. So chairman should see that there should be ensure a regular external board evaluation. That means some external board should evaluate their performance, and at least in every 3 years, and that should be done if the company is a part of FTSE 350 companies. The annual report should describe the work of the nomination committee and all details related to its functioning. Then comes the audit committee, one of the most important committees. Who will establish the audit committee? The board. They are the ones who are going to establish. Minimum number of members in committees, 3 in case of big companies and 2 in case of small companies. The chair, the board should not be a member of audit committee. And who are the ones you see? Members, independent non-executive directors, minimum 1 member to have financial experience. That means should be in the from the field of finance. So what did you see here? Who will establish the audit committee? The board of directors. Minimum number of members in audit committee, 3 in case of big companies, 2 in case of small companies. Okay. And who are the members? The independent non-executive directors. Minimum 1 member to have financial experience. Any one of them. Okay. Did you understand?
Yes, sir.
Yeah.
Among 3, one should have.
See, minimum number of members in audit committee is 3, right? And in case of big company, small company, 2. Okay. Chair of the board should not be a member of the committee. Okay. And who should be the members? Independent non-executive directors. And amongst them, one should have a financial experience. Now understood?
Yes, yes.
So non-executive directors can only be a part of audit committee, as clearly mentioned. Okay. The board will make the committee. What are the roles of audit committee? Monitoring the integrity of the financial statements, whether the financial statements are prepared fairly or not. Providing advice on whether the annual report and accounts are fair, balanced and understandable. Reviewing the company's like internal financial controls and risk management systems, of course. Monitoring and reviewing the effectiveness of internal audit function, because they are the audit committee is doing, right? So they are the ones who are who have to get the audit done in the company. So they have to see the audits are happening properly and effectively it's happening, and that effectiveness should be reviewed and monitored. If there is no internal audit function in place, they should consider annually if whether there is a need for one and make a recommendation to the board. That means if audit is not happening once, it should be happening, that they have to ensure. Making recommendations in relation to the appointment and removal of external auditor and their remuneration, they are going to recommend that in some cases. In which cases we will see afterwards. Reviewing and monitoring the external auditors' independence and objectivity and the effectiveness of the audit process. Who have to do that? The audit committee, which has board members. Developing and implementing policy on engagement of external auditor to supply non-audit services. Right? That means some suggestions on some matters. So what is that they have given here? The audit committee composition, objectives, function. They will be checking the financial statements, controls, internal audit is happening properly, external audit is happening properly, and if there is any problem, whistle blowing. That means they should bring out that matter. Objectives of getting the audit done is to increase public confidence, financial awareness of non-executives, and liaison with external auditors. That means they are the one who are between the management and the external auditors, correct? Now, and composition, minimum of 3 non-executive directors, I already told, audit committee, and at least one with financial expertise. Corporate governance, clarifications and descriptions in annual report. Clarity must be given in the annual report about the work of audit committee, external audit process. The ones the practitioner comes and does that in the company, right? So how they have done internal audit function, if it exists, when it then its details, and if there is no internal audit function, then an explanation for the absence. Also, the board must state if using the going concern basis of accounting for the business is appropriate and identify any material uncertainties to the company's ability to continue to do so over a period of at least 12 months from the date of approval of the financial statements. That means there are many companies which are into seasonal businesses, which are not able to sustain or which are not able to run their functionalities for the entire year. So whether it is important for them to whether they have the ability to continue for the full 12 months period or not, or whether they should come in the category of what we say like going concern basis or not, that should also be ensured. Okay, next. Just give me a second. Then comes the internal audit function. Internal audit works closely with audit committee. The audit committee has to see, audit committee is the one which gets it done, right? The audit committee has to ensure that internal auditor has direct access to the board chair and the audit committee. That means internal auditor can directly speak to the chairman and the audit committee, which comprises 3 non-executive directors. That means who is ensuring that the audit committee, that internal audit works, the one who are doing the internal audit under the supervision and guidance of Audit committee appoints people to do that. They can directly have access to board chairman of the board and also audit committee. Review and assess the annual internal audit work plan. The audit committee has to do that. Receive periodic reports on results of internal audit work, which is very important for seeing whether internal controls are intact or not. Review and monitor management's responsiveness to internal auditors' findings and recommendations. Okay, how the management is responding to the internal auditors' findings and recommendations, which they make to the management, whether they are taking it seriously or not. Meet with the head of the internal audit at least once a year without the presence of management, and monitor and assess the overall effectiveness of internal audit. Who will do that? All the audit committee. Risk committee has to take care of the risk aspect. So risk committee advises the board on company's risk appetite, how much risk company can take, what risk the company is exposed to, reviewing the risk and approving the risk management strategy. Okay, that means how effective the risk management can happen. Risk map is usually used by companies to identify and assess the risks. So this is a risk map. So this is low, okay, low, this is high, okay, then this is high, this is low, fine, this is high, this is low. So if the risk is very high, I mean to say this is impact and this is likelihood. If the impact is very high and the likelihood of happening that kind of likelihood of something happening which is very risky is very low. Okay, some event which can happen, okay, whose impact would be high and whose likelihood would be low. Okay, you need to transfer that kind of risk. Okay, if the impact is low and the likelihood is low, you can tolerate that risk. If the impact is like very high and the likelihood also very high, you can terminate that. Don't do such kind of work. Okay. So here it is very clear, right? If the impact is high and the likelihood is low, you can transfer. Here you can tolerate. Here you should not do that work. Here, if the likelihood is high and impact is low, you can treat that. Okay. So for you, the homework tomorrow is what kind of examples you can bring for these 4 types of risks. I'll be waiting tomorrow with your answers. Now, internal controls and risk management. Internal controls must be put in place to minimize the risk faced by a company, of course. Role of directors in that is it is the director's responsibility to implement and monitor the application and effectiveness of internal controls. Auditors, role of auditors are not responsible for the design and implementation of control system of their client. Auditors just have to assess the effectiveness of these controls. That's it. These are the ones responsible for implementing. These are the ones who are responsible for assessing the effectiveness. Remuneration system, principles of good remuneration package. It must promote the long-term sustainable success of the company. If you are giving remuneration to someone, a very high package to someone, they should ensure that they make the company successful and sustainable. A formal and transparent system must exist for executive directors remuneration. That means how much directors are taking the money from company and on what basis. The breakup should be very clear. Any director must not be involved in setting their own pay. That means they cannot themselves decide how much pay or money they should take, because these are directors, not the owners. Remuneration committee will decide that. Directors must apply a proper judgment to authorize remuneration by any individual, considering the company's overall vision and the performance of candidate employee. That means company's vision is to reach somewhere in the future, right? So proper judgment should be made by the directors to authorize the remuneration for an individual and see that how they have performed to achieve the company's goals and targets. Remuneration committee, it frames the policy relating to remuneration for their chair, how much the board chairman should get, executive director should get, and senior management should get. And there are some 3 members also comprising of the remuneration committee is comprising of 3 members. 3 independent non-executive directors should be there. NED remuneration is determined by the board, which must not include share options or other performance related elements. Remuneration can be in the form of shares having a total vesting and holding period of 5 years or more. Only basic salary should be pensionable, not any other benefits apart from that. Notice or contract period should be 1 year or less. Only in case of new directors, this period can be more than 1 year, but only for initial period. That means how much they have the contract. Notice related to that. Auditors reporting responsibilities. So ISA 7 UK 700 requires the auditor to report by exception in the auditor's reports clearly disclosing the compliance with UK corporate governance code. So that means auditor should clearly mention whether the compliances are intact in the company or not. Okay, and also what they should do, they should report by exception. What do you mean by report by exception? Yes. What is deviating from the standard or norm should be mentioned. So UK ISA UK 700 requires auditor to report by exception in auditor's report. Okay, report by exception in auditor's report, clearly disclosing the compliance with UK corporate governance code. So exception report lists the documents that are missing from organization. So whatever is missing out, they have to report. Are you understanding? Hello.
So.
Yeah, whatever is missing, they should be disclosing that. Just a second. So they have to disclose very clearly where the companies, where things have gone wrong and the performances have been deviated from the actual. Okay, and why the things have gone wrong or where the things have gone wrong, and most probably in negative, like why the negativity is there. Okay. So annual report must include a statement by directors that they consider the annual report as fair, balanced and understandable in assessing the entity's performance, which is inconsistent with the knowledge acquired by auditor in course of performing the audit. So the statement of directors that everything is all right, everything is very clear, understandable, and assessment about entity's performance, which is inconsistent with the knowledge. That means the auditor should not be knowing that priorly. Okay. After audit, after conducting audit only, they'll be coming to know that, but they should not know that before. So this kind of statement director should be giving. A section explaining the work of audit committee, which has not been appropriately addressed, which were communicated by auditor to the audit committee. An explanation as to why the annual report does not have a statement which is materially inconsistent with knowledge acquired by the auditor during the audit. So if anything is wrong, they should mention that something which the auditor is in denial mode, that they don't have knowledge of. So an explanation as to why the annual report does not have a statement which is materially inconsistent with the knowledge acquired by auditor. That means what auditor is getting to know and what they are showing is not in consensus, and other information that in the auditor's judgment contains a material inconsistency. That means something which is wrong. So all these things should be mentioned. Okay. So this is the chapter of corporate governance. Any doubts if you have, you can bring to my notice tomorrow. And please read this chapter. We are done with first 3 chapters. Let me be clear. And I want you to write test on these first 3 chapters. When are you going to write? Hello? I'm asking. Sorry, Monday?
Sunday. No, Monday.
Sunday? Okay, Sunday. Sunday?
Okay,
No
sir.
worries, then Sunday I'll take the test. Okay? Hello?
Okay, sir. Okay.
Okay, any doubts, please bring to my notice tomorrow. Yeah, thank you.
Okay. Bye, sir. Thank you.
Bye. Thank you. Bye.